What's going on, everyone? I am Charles Moon, the disciple of trend, and this is my podcast, Buy High, Sell Low. Just want to mention that stock and stock options trading does involve a substantial degree of risk and may not be suitable for all investors. Past performance is not necessarily indicative of future results.
Welcome back, everyone. What's going on? Thanks for tuning in to the Buy High, Sell Low podcast. Infotainment at its finest with your host, the disciple of trend, Charles Moon. Yes, my own hype beast, my own hype machine. But I am here today because I want to talk about something very interesting, okay? Very interesting in my opinion. I actually held a webinar this week and I threw out a question. It wasn't that big of a webinar. It was about 300 people that attended. But I threw out a question, and the question was, what do you struggle with the most? And two things came up. One was timing. It's always about a timing issue. So that means people's intuition was pretty good. It was just the opportunity was either too early or too late. And then number two, which was more surprising than you would suspect, it was taking profits too early. So I'm going to give you a couple of exercises, I guess, a couple of pointers that you could either take or not take and move forward with, but I believe that they could legitimately solve at least some of your issues and have you going down a more correct path. Now, for investors, it's different. Timing is just pulling the trigger in essence. And ultimately, as investors, I say never go, full on at that moment you are ready to purchase. As an investment, if you are a believer in that company and you want to see, you believe that there's growth and you want to see that growth, don't think it's just going to run away without you. Even if it starts going, you could always add on. You may have to add on higher, but a lot of the times people have the ability to build their position slowly at lower prices by just accumulating and cost averaging. Now, when I use the word cost average, it's usually in a negative connotation, right? It's usually with traders that don't want to take a loss, and so they try to drag their price down so it's easier to get back to break even or even turn a profit. But that also means that whatever risk allocation you initially went with on that trade, you've in essence had to either double in size or greater. And that's never a good recipe, because if it starts going wrong when you're supposed to take a $500 hit or a $1,000 hit, or even for some of the ballers, a $10,000 hit, it gets magnified greatly and very quickly. And all of a sudden you're anticipating potentially 5, you're now at 1,000 or 1,500. Or you're originally looking at maybe 1,000 initially, now you're at 3 or 10 and you're at 25. Those are big dramatic differences, because that's additional capital that you don't have for the next opportunity, which could be the one. You just never know. And so when I usually reference cost averaging with my clients, I use it in a negative connotation. But as an investor, I believe it's a smart move. It just depends on what you're looking to do with your portfolio. Ultimately, building up your position is the exact same thing that hedge fund managers and institutional managers will be doing. They don't just go all in with a multi-million-dollar position unless it's needed. And generally speaking, they would have to do it through dark pools unless they went market, which would cause a dramatic shift in a stock price. It could cause undue panic. It could even bring on the thought process of manipulation. So in turn, what funds generally do is over maybe a quarter or several weeks, they'll just slowly build up their position, buying in and adding on at higher price points, or if the stock reverts down, they just keep on buying in on the dip. And so that way you have the ability to build up your position over time, get it at a favorable price range, and then, of course, if things work out, and hopefully they will, you could slowly start unwinding, in the long-term future when you're very happy with the yield you have received. But getting back to, let's say, let's talk about the timing, okay? The timing of the markets. It's difficult because, one, you may be right, but not be rewarded for it. Or two, you believe that you were going to be right and you were totally wrong. And sometimes you're a victim of circumstance. It's happened to me. Facebook has been my nemesis this year, even though in one of my podcasts, I told you how much I love Facebook. Every time I've been in Facebook, I've been hit with news. Now, if you've been tracking Facebook this year, you've noticed how often throughout this calendar year that Facebook has been making headlines and how volatile their stock has gotten. And so I have gotten pinched by that. Okay? It happens. It's the course of trading. It's the nature of the business. Remember, we're talking about, yes, the macro markets, but unless you're trading the ETFs of the macro markets like DIA or the 3Qs or SPY, each individual stock within the market has its own lifeline. It has its own, ecosphere of news and fundamentals and obviously demand and supply. And so certain news could have effect on a stock. It may not even have to do with the company directly. Quite honestly, a stock in the sector could positively or negatively influence the stock price because of the similarity, the symmetry, the thought process that if one company who is perceived as one of the leaders is struggling, then everybody must be struggling. And so if, let's say, NVIDIA or Intel reported horrific earnings, it's not like the entire semiconductor sector wouldn't be down the following day if Intel was down 5% or NVIDIA was down 5%. Most will follow suit, maybe in some degree even worse, but ultimately they'll feel that weight. And so sometimes timing can be an issue where you're just not attentive enough to other things that are surrounding that particular company. And maybe you are a victim of circumstance. I always say, pick yourself up, dust off, be prepared for the next opportunity. Can it have some mental effects? Of course. We're all human. Nobody goes into the market planning on losing, right? They don't want to lose. But that's the problem. They don't plan on losing. Just because your money is in the market does not mean you are entitled to win. That entitlement attitude is what really holds a lot of retail traders back, because they sit at their desk all day. They feel the market owes them something if they're sitting there watching charts, or if they decide to buy, it's like it has to win. Even professionals have that attitude. I humbly do my best to never feel that entitlement, but even I can succumb at that time. Like, the woe is me, why does it happen? Hey, but it's really just like a 10-second thing for me. And hopefully you could train yourself to keep it as a 10-second thing also. It's just a one-off, on to the next one. If you are buying too early and the stock pulls back and then goes in your favor, and maybe a lot of that decision was based on intuition. The intuition was good. The price point wasn't. Figure out as to why those particular price levels were too much of a premium at that time. If you do enough research, and I'm not saying scour with a magnifying glass over the chart, don't sit here and read 700 different blog reports on Seeking Alpha and CNBC. No. If you just do your due diligence, if you ask yourself questions, why was I on the wrong side at this time? Was there a attributing factor? Was it just the fact that I went after it too aggressively? And if you missed it, were you too passive? So timing can be as simple as basic human emotion, but timing can also be contributed to the fact that some people just don't understand technical analysis. They may have a good feel for the markets, but they don't have reference points. And maybe some of the reference points that you are working with hasn't been that successful for you. So why do you want to keep forcing this opportunity to work? What I do in the markets, I will never say is absolutely perfect for each individual out there. What I feel is that I could teach a broad mass, a very simplistic approach once you break it down. And then from there, we have to start developing your intuition and really teaching you when to step on the pedal and when to pull back. Some people think that every single day the market environment stays the same. In the summertime, it kind of does. There's just very limited activity unless there's news. And even when there's news, it's not going to be as significant as it may be during other periods. It's the summertime. Summertime trading is historically slow. Sometimes that means we're trying to fit a square peg in a round hole. What has worked great months past may not be the best way, best way or approach to the current market conditions. Now, ultimately, if you are proficient with technical analysis and the current methodology you're working just isn't yielding what you're looking for, step back and truthfully ask yourself, can I be better? Is this the max and peak potential I can be? If you're saying yes, then you better be doing well. And if you're not hitting your goals or exceeding them, then it's quite honestly a self-realization moment you have to have and say, is this for me? Listen, there is no cookie cutter way and approach to the market based on our background, based on how we were raised, the environment we were raised, based on our beliefs, based on our education. Not two traders are the same. I could teach people exactly what I see. I could teach them the proper mechanics and really the shape and slope of my entries. But my assessment of risk may be different based on your assessment of risk, even though we'll be looking at the same price entry with the same risk parameters. For some, they'll say it's not enough risk. For others, they'll say it's too much risk. This isn't, if you think about owning a diner, not everybody drinks their coffee the same way. Some like it with cream and sugar, some like it black. So ultimately, you got to fit within your personality and where you are comfortable. And if you have this approach and you are finding success, what ends up happening is confidence. Confidence builds. Winning breeds confidence. The belief system strengthens because you have proven to yourself this can work for you. That's the problem. People do get upset. They say, I see this working for him. How can it not be working for me? It's a scam. It's not. All right. Okay. Some instances in our financial world, yes, there's some total pieces of shits out there. Okay. But I specifically do my best to make sure that people understand I'm here to coach you. I'm not here to feed you signals to build up your portfolio. Can you mirror my signals? Earn while you learn? Yes, if you want to. If you really must, you do what you want to do with your portfolio. The first thing that I offer up when I know someone is brand new in my room is to watch a video. And the one thing that I emphasize in that video, do not trade with live money practice on a simulator first. There's more than enough time for you to make your ROI. You have to try and learn this first. At the very worst, understand the mechanics of what I am trying to do, especially if you've never traded before. How do you expect to be able to actively trade off the bid, off the offer, and know exactly what to do? The order types you have to place. There's a lot to it. It's not just analysis. It's also execution. Remember, I'm a jack of all trades. I do position signals. I do swing signals. I do intraday scalping. And I teach it all. Some people are incredibly good at intraday trading and can't do position trading worth a lick. And then there's those that absolutely kill it with the longer term signals that just have absolutely no desire in being in and out of the market that quickly. Again, to each his own. And a lot of that, and as a trader, some people tend to take profits too quickly. So I say to them, if you're going to go that route where you want to be in and out of the market very quickly, that you're fearful that money may not go, but just will disappear because you've seen how stocks have pulled back. Don't give yourself that wide a risk if you're only going for that reward. And if you are more comfortable being in and out of the markets, perfect. Why don't you look shorter term? Well, I don't like day trading. Well, you like taking, 20% profits on an option. Why not? You could get that by being in the markets for a very limited time if you know what you're looking for. And if you spot that opportunity, you clearly are not hesitating to take them. So why are you taking on $500 to $1,000 of risk when you only have to take on $100 to make the exact same amount that you're working? And in fact, you could actually leverage your position, right? Still be in the same comfortable risk parameters that you're in and actually make more by doing the exact same thing. All you're doing is, instead of maybe taking on 2 contracts, you take on 4. So if you're making $50 on those 2 contracts, now you're making $100, and you're doing the same thing in and out. As a day trader, you have to kind of have some semblance of impatience, right? You have to be very, I don't want to say jittery, but you just have to know, right? We're not in it for 400% returns. That's just not what we're doing as day traders. If we're scalping, we're actually looking for small returns with leverage positions. If we want to hold on a little longer, we definitely have to reference price levels and indicators that are going to give us signs of weakness and then decide very quickly whether to cut bait. It's always better to walk away with $50 than walk away with nothing. It's always better to walk away with $300 because let me ask you how many jobs do you know that can make $300 for you in less than an hour and maybe even minutes? I mean, there's not too many opportunities for the average Joe in this world to be able to do that. And that's what day trading can provide. Now, for the longer term, patience is required. A broader outlook is required. Research and know-how of what's happening with the macro markets and also nowadays geopolitical news. These are all important because these all could have huge effects, both positively and negatively in the marketplace. So it does require you to get your hands dirty just a little bit more. And some people say, well, I don't want to do that. Well, then stick with your investment advisor, your financial advisor. I don't really like what he's doing. Well, then figure it out because it's one or the other. It's one or the other. You're either happy with that 4 to 10% that guy is offering, or you take control and quadruple it. And it's not like you have to be in and out of the markets a lot. You just have to give a damn about your money. So for me, timing can be an issue. Sometimes it's out of your hands. Sometimes you're just not strategically prepared, in my opinion. And sometimes it's just the human emotion getting the best of you. There is no perfect way to answer this. I will say, if you want to devise a plan, sometimes chart patterns do work. There's a lot of free information out there. You could always look it up. Candlestick patterns, people swear by them. But having a solid core methodology that you could believe in does wonders. It really does. And I'm not here to pitch mine, okay? I've never and will never use this platform to promote my program, okay? I may talk about what happens, but I'm not going to sit here and say, call blah, 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 or go to this website, blah, 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 blah. Anything that's posted underneath, guys, is not by me. It's by my company. So respectfully, you're not going to see this huge web address that comes across this podcast. No. This is literally my platform to help you guys and gals, whether it's with trading or giving you guidance on stocks to watch, which I'm going to do here in a little bit. Or maybe just talking you guys up, making you feel better because you've struggled and you've reached out to me. I don't know. I don't know where I want to go with this, but I want to help people, and that's why I'm doing this. And so a lot of, timing can be offset by planning and preparing. And a lot of that comes with having an approach, a methodology, a rhyme, and a reason. I'm never going to say you need one, but it helps. The purpose of a methodology is not to give you the Holy Grail. The purpose of a methodology is giving you a foundation to build off of. Whether you want to build a ranch or a 2-story or a 10-bedroom mansion, that is up to you. It's how solid of a foundation you could build for yourself and how much you want to branch off of it. The best traders I know are always looking to improve. They're always looking for ways to adapt. They're always looking for certain nuances that's going to quintessentially give them an edge. There's no real rhyme or reason. Everybody has the same answer. Volume, momentum. Well, yeah, great, thanks. When you tell that to the average person, they say, what does that mean? What they mean is if you respectfully gauge that volume, okay, so on my methodology, I track on the daily chart the last 50 trading days. That equates to, in essence, 2.5 months of trading. The daily total volume. When I see volume increase above that level, I have to wonder by how much. Okay, 2x, pretty impressive. 4x, that's a lot of money, guys. If it was like a $3 stock, I may not really care about. But we're talking about a stock that's $149, quadrupling in volume, when their average in volume is at 3.3. That's a lot of new introductory cash flow. So something is up, whether it's news, like IBM, for example, who I want to talk about. It's definitely earnings. Sometimes it's secular. Sometimes it could be in something as simple as an initiation. But ultimately, if you could find these high levels of volume, greater than normal volume, and stocks trading in a greater than normal range, and based on how it opens and closes, like in this instance right here on June 4th of IBM of this year, it opened at 129.56. It closed at 132.69. The total days range was $3.66. The average true range, meaning what the stock normally trades in over the last 30 trading days, was 2.42. That's a big jump. That's a 50% jump in normal daily trading activity. The volume wasn't that significant, but it was big enough. 3.56 million average. It came in just a touch under 4 million. So again, about 400,000 shares extra, but you multiply 400,000 times, let's just say $125. That's a lot of cash flow. The follow-through effect is that since this momentum bar at that 129.56, about a month and a half ago, IBM is now at 149.63. You tend to see these momentum bars in both direction, and then there's follow through. For me, the momentum bar states as this: when a stock trades over their 50-day average in volume for the day, and it trades more than their normal average trading range over the last 30 days. ATR, average true range, but it's really the trading range. And so from the high to low, on average, if let's say for IBM is $1.50, that means on average they would say open at 120, and on average may go up to 121.50 or may go down to 18.50. But ultimately they average $1.50 from the very high of the day to the very low of the day. Well, all of a sudden we see it trade outside of that range on more volume. Something is not normal. Something is happening. And based on how it opens and closes, say it opened at the high and closed at the low, that'd be very negative. If it opened at the low and closed on the high, that's very positive. And this, by the way, can work on other time frames as well. You'll see, generally speaking, some sort of carryover and follow through. In some instances, it could be very dramatic. No, there's no definitive how much it's going to move. I can't predict the future. I assure you I wouldn't be doing this podcast if I could. You would never hear from me ever again. Come on. Don't. That's the one thing that clients ask, and I say, I can't predict the future, but I could tell you what may potentially happen. And that's the thing. I get reference points. It may seem like it can predict the future, but I'm only going to give you a play-by-play of what could happen based on these structural levels that we see. And a lot of this is based on past historical references, trading behavior, consistency. Traders are creatures of habit. But this momentum bar, if it trades outside that ATR, if it trades above that average, it opens from low to high. Do your research, ladies and gentlemen. You'll see. Carry it over. Pull up on your charts. Start tracking it. Now, as far as letting trades go too quickly. Okay, so you have to ask why. For me, I don't have predetermined amounts per se, but my general rule of thumb is that in my program, we're going to be going after, on our position signals, 5% of the stock price, then 10% of the stock price, and all you can eat shortly after. But I'm not going to force myself to take profits at a specific price level if there's major resistance prior to that price level, or major support prior to that price level. Reference important levels of interest. And if you don't know, yet again, this is why it's important that if you want to be a trader, you have to have some ideology of technical analysis, whether it's basic or advanced. I like to think theoretically my ideology is advanced, but it's very simple. Major swing highs, major swing lows are important prices of reference in the near term. They tend to become double bottoms and double tops if there's no range extension beyond. When there is range extension beyond, unless it completely collapses, it's saying that we're now getting higher highs and eventually higher lows, which equals uptrend. And if it's inverse, it equals downtrend. It's pretty simple in that nature. But at some point, these points of references will come into play as a potential ceiling or a potential floor. So it's important that you at least acknowledge them when you are trading. As an investor, totally different. You have to look at the bottom line and see, right? You have to look at valuations, growth potential, yada, yada, yada. But as a trader, and I hear so many traders talk like this, don't. Because now you're enveloping two different ideologies, methodologies. It doesn't mean it's going to work. You wouldn't mix apple pie into a bowl of spaghetti and then eat it. You would do it after the fact, right? You would eat one and eat the other. Both are amazing on its own, but together, I mean, some people may enjoy it, but you know what I'm saying? So that's what you're doing when you're researching baseline fundamentals to decipher whether this trade is going to be good or not. You're not going to be in it long enough for that valuation to truly play an effect. This is as simple as I like to get with fundamentals outside of news, because news could affect stock price. But let's say a company coming off earnings, if they raise guidance, good. They lower guidance, bad. Do they beat? Who cares? Because stock price is not reflective of the current EPS and sales revenue. It's not. Because if that company raises guidance, good. If it lowers guidance, bad. Right? So if you wonder why a stock could steadily beat EPS, generate more revenue than expected, and then go down on earnings, and it may be because they had to lower their full year 2019 guidance because of a one-off event, or maybe they see a weakening in growth, or maybe they see Q3 being a very down month and they could have some, who knows. But ultimately, guys and gals, stock price is a reflection of future valuation, not current, future. Right? Because if you think about it, that's the only way you can make sense of Tesla's price. Not the car price, their stock price. Think about it. Think about it. For the longest, they sold like 40,000 cars. They were like $300 per share. Are you kidding me? No wonder everybody wanted to short them. No wonder Chanos has like a multi-billion-dollar short position. Jim Chanos hates Tesla. He emphatically hates Tesla. So that's the thing. Don't meld the two. For me, if you have straight-on difficulties from, let's say, an emotional standpoint where it envelops you, you're just like, I got to take this money and run. If you plan on swing trading and holding these overnight, once you execute the trade and you actually have a stop in, man, sometimes it's best to just walk away or put in predetermined goals, because if you take that money, you can't feel bad. I always tell my clients, never feel bad about taking money out of the market, because it could always be worse. Oh, I took it too early. Okay, you know what the attitude with that is? The problem with that attitude, by the way, the problem with that attitude is that you sit there and you watch the stock and say, man, I could have been in, instead of thinking, man, how do I get back in? Always another trade. If you have to put a post-it next to your trading computer or your trading screen, write, there's always another trade. If that is how you're at after years of trading, it's very difficult to force yourself to hold on longer. There's exercises you can do. There's trust that needs to be developed. So unless you're going to work towards actually increasing or developing that trust, you are forever destined to trade this way, because that is how you trained yourself. So make the most of it. Oh, I got out too early with profits. Stock's going up. Okay, look for another trade. Do you see one? Yeah. How's the risk reward? Yeah. Well, if you liked it before, why wouldn't you like it here? Oh, because it's too high. But you thought that it couldn't go any higher, and it did. So now what? Don't make excuses. Make decisions. It's okay if you take it too early. It's not okay if you don't consider another opportunity. If you just sit there and complain, that's when you're screwing yourself. It's okay. You're not going to be perfect. You're not going to buy in at the feet and sell at the head. If you do it, great. It's always nice to be lucky. Guys and gals, respect the fact that you walked away profitable. That's a good thing. The other exercise that I could recommend is use a trailing stop. What is really the best exercise is to use what's called a cover and run strategy. You want to take profits off the table early, okay? Oh man, it's getting a little nerve-wracking. I have 500 shares. So if you take just half of that off and then you move your stop up to break even, at the very worst, you're walking away profitable on at least half your position. And if you just let it sit there and the momentum carries away, you may be able to make way more on that second half. Cover and run means you're looking to take risk off the table. You're still allowing risk on the table to work in your favor, because if your assessment is correct, it's going to continue. If not, well, you've managed yourself to take the risk out, but you gave yourself every chance at success. What does that mean? So let's just say 200 shares is your current trade in IBM. You bought in at 145. Your original stop was 143. So 200 shares, okay, with 2 points is $400 in risk. Well, it went up to 149. Now, if you took 100 shares of profit at 149 and you keep your stop at the same price, which is 143, obviously if you changed your share size and you adjusted your share size to just 100, it could come from 149 to 143 and take you out of your trade, and you still walk away plus $200 in profit gross. Let me state that again. If you buy into IBM at 145 with 200 shares, your stop is at 143. So at risk, you have $2 per share. Now, this is not a trade recommendation. This is an example. Don't just buy at 145 because I'm talking about it. I have no idea if 145 is of any reference. But if you say worst case scenario, buy at 145 and it goes straight down to 143, you're going to be out of the market with a $400 loss. But let's say you weren't right and IBM went and did what it did today. And you said, oh, I got to take some profits. Normally, you may have just taken profits at 146 and made $200 and been happy. But if you had that momentum and it's at 149, you could take $100 profit. 100 shares for $4 profit, which equates to $400 in return. You still have 100 shares that's currently up above your entry. And if you keep your stop where it is, which is $2 per share, if it does somehow, unfortunately, come all the way back, on that current 100 share position, you will lose $200. But because you did a cover and run strategy or actively managed, you made $400 on the first half. So total 400 minus 200 equals 200 profit. Now, if you say, well, what if I couldn't hold to 149? That's fine. Say it got up to 146 and you got jittery and you want to take $100 profit there. Okay. Take 100 off. And now, at the very worst, if it does come all the way back, you're in a scenario where you're minus 100. Right? Because you made 1 point on 100 shares, but lost 2 points on the other 100. So you could offset that by moving your stop to break even. Put your stop at 145. So now you've rewarded yourself with $100. And if it comes back to 145, your second half is zero outside of fees that you have to pay for that trade. But you're walking away a winner. Now you say, well, maybe I'll just keep it all on. Okay, then. Then in that time, you have to say, I need to move my stop up in conjunction. If you don't want to manage your trade, you have to manage something. You have to do something. If you're going to put yourself in a position of success, when you're successful, make sure you stay successful. Guys and gals, I have to be honest with you. If you don't know what I'm talking about, you either have to do your research or you have to ask questions. But ideally, simple management can make an immense difference on your portfolio. I am not kidding. If you are struggling, if you're at break even for the year, if you're down for the year, these little simple measures that I've talked about in regards to timing, which is a little bit more complicated because it does involve a methodology, but at least in regards to locking in profits, that's an important aspect. You yourself have to figure out where you're comfortable with. For me, the timing issue, you're going to be snake bitten at times and you're going to benefit at times. It's the karma theory. It happens. Market giveth, market taketh. It is a very common theme. You can't perfectly time the market every single time you want to get in. You just can't. So the sooner you accept that, the sooner you're okay with that. And I tell my clients, it's a matter of acceptance of the loss. It allows you to let go of a bad trade, even under the worst circumstances, even if it's out of your hands. Your assessment was beautiful. Structure, opportunity was beautiful. And it just didn't work out. Don't worry. There'll be a time where it's not as pretty, not as clean, not as perfect, and it could be one of, if not the best trade of your life. That is trading. So once you can wrap your ideology that your mind, not the ideology, the idea, wrap it around your mind, wrap it in your head, slam it in there, that the market is not out to get you. Do you hear me? They don't know John Q is now pulling up and turning his computer on. And as soon as you enter the market, they're like, we're going to get him now. As soon as you let go of that, the easier it will be to focus on the task at hand. And that is your growth as a trader. Your growth as a successful trader. You can't live and die by each individual trade. Look at the body of work. Look at the basket of information. And if you can find success and it starts becoming consistent, you can be very successful in the marketplace. Just because you're in the markets does not mean the market owes you anything. Last but not least, please don't think you're going to buy any stock in this world and get supremely rich. It's the same thing as buying a lottery ticket, guys. It is a grind. You're in it to gain small percentages at a time. If you take on 100 trades, and on average, you're winning 50% of the time. So you have 50 winners and 50 losers in all of 2019. But if your winners average 2.5% and your losers average, let's say 1.5%, your portfolio gross will be up 50% for the year by being a 50% trader. Do not care about your win-loss ratio. Look at your P&L. Is it growing? What are you on pace for? Some people are like, I'm not even up that much. But if you average it out to the end of the year and it turns out to be 16%, that's greater than you've ever done, give yourself some credit, ladies and gentlemen. It takes time. For some, it comes incredibly quick. For some, it never comes. But I do believe if you are guided in the right direction and you learn the proper assessments, you take on the proper risk, there's going to be a lot of times that you're going to be able to just get lucky. You know what? I got lucky. I actually got a volume alert in LinkedIn. Okay, this is before Microsoft bought them. And I said, okay, well, this is a pretty good move. And so I just slowly started buying up options. I bought a few weeklies, a few monthlies. I bought at different strikes based on premium pricing and what I was looking for. And so basically I was playing it from anywhere from 1 week to actually it was about 1.5 months. And I had a total of around 8 contracts, I believe. 3 days later, LinkedIn got bought out. There's nothing special about that. I didn't know. I just thought there was some short-term momentum, and if it didn't work out initially, that I was also giving myself some time for it to eventually work out, because it was trending up. It was actually a really nice opportunity. And so it actually ended up setting a trade setup for me, which I'll discuss one day, called an inside bar. I bought in, and contracts that I paid anywhere from I think the cheapest one I paid was somewhere around 75-80 cents. Some I paid up like $3.50. I mean, these contracts were going for like $30, $32, $35. Just get lucky. I think I eventually cashed out between 26 and 28. I thought I was trying to hold out for 30. Mike's just like, take it. So I took it. I'm like, all right. Listen, you just get lucky. He even said it to me. He's like, you got lucky. Yeah, that's trading. It happens. Sometimes you get unlucky. It happens. But in between those parts, there's got to be a rhyme and a reason. There's got to be structure. And so in turn, if you have that structure, it does make things easier. If you have that plan, it makes things easier. If you're prepared, you know what to do. Now, the only question at that point is, are you going to be disciplined enough to do what you should do? Only time will tell. That's every individual. Sometimes they make decisions that's going to have a butterfly effect very positively for that trader. Sometimes it'll be a very negative one. All I could say is that I could give you advice, not just from my own experience, but from experience of working with thousands of clients. And you could just take it as you like. You could believe me or you don't. That's fine. Like I said, I'm here to help. And if you want my help, this is it. And if you don't want it, I'm sorry, I tried. All right, so we're gonna wrap this up here shortly. I do want to spend the last 10 minutes talking about a stock. Yes, this podcast is long. I had a lot to say because these were 2 important topics that were covered in my webinar, and I don't feel I gave it sufficient enough time. And I feel like I didn't even really do that right now. I feel like I could talk more about it, but I certainly don't want to have a 3-hour podcast talking about the same thing over and over. But I do want to talk about IBM. And so if you decided to listen all the way to this point, thank you. Because we're going to talk about IBM. And we're going to talk about a stock that I believe now has a much higher ceiling than a lot of people on Wall Street may anticipate. We'll have to wait and see. Today, it was quite the move in IBM. An $8.11 range. It was actually down to open the day because it was down in pre-market action. It was initially up and then it went down. So why did we see this jump? and $8 range. Now, before I get into the why, I want to mention this. I started doing some research. You see this? 477, 565, 541, 519, $8.11 today. I checked over 1 year, 3 years, 5 years. And it wasn't until I got on a 10-year backlog of data was there a trading range that was larger than today's. All the way back to 2010, IBM had an 11-point trading range. Even on the low here, this huge trading range was only 545. The significance of that is that this is fairly historic. Again, IBM hasn't seen this kind of action in nearly 10 years. So why, when it was down? Listen, they reaffirmed their full year 2019 guidance. They didn't raise it, they didn't lower it. They just said, yes, it's going to remain the same. Their other services are showing a decrease in revenue. That's a pretty negative for a company. It wasn't until I heard this, okay, that I said in my head yesterday in my office, okay, and I did say it to my coworker. I said, oh my God, IBM has a chance of going crazy here. Because their cloud revenue rose. All these other services that IBM provides went down, but cloud revenue grew. If you're unsure of what cloud revenue growth does for a company, especially when it's somewhat surprising, you could look at what Amazon has done over the last few years, but most notably, you could look at what Microsoft has done with Azure. Now, IBM will not be able to compete on the same scale as Microsoft and AWS, but let's not forget they absorbed Red Hat. And Red Hat was one of the major players in cloud. Hence why IBM felt they had to pay a huge premium, which they did, to secure Red Hat. This is a part of their master plan to grow their cloud business. And they're doing it. And now they're adding Red Hat's portfolio into the mix. When you assimilate cloud in this marketplace, look at Coop, C-O-U-P, look at Veev, V-E-E-V, look at Twilio, look at Workday, look at OKTA, look at every single cloud-based platform, cloud integration, cloud IT consulting and security and cybersecurity and IT services. CYBR is another one. Look at them all. PLAN, look at them all. And what they've done in 2019. I'd say on the low end scale, probably around 60 to 70% in growth. On the high end scale, somewhere between 100 to 140% in growth. No, it's not Shopify, but Shopify is on a standalone. But we're talking about an entire sector. And if you're not moving with that sector, like Cloudera, for example, well, you see what those stocks are doing. Where everybody else is going. It's supposed to sound like a rocket or a missile. I'm pretty sure I sounded like a complete idiot there. So what did IBM do today? Just going. And for me to think that they're going to slow down here at 150 to 154, yeah, for sure. This is going to be an important price reference. But I will state this. If the markets continue in their auto mode up, If the FOMC continues to willing to be accommodative, regardless if we make a trade deal or not, there is a great chance that the S&P 500 continues to move higher from here. I believe at this point Morgan Stanley is giving somewhere around 6 to 8% more upside this year, the rest of this year. That means my thinking with IBM is that if they make new 52-week highs, they could be much, much, much closer to 200 than they will be to 140. Now, I don't want to say that it can't go to 140. It could easily go back to 140 from here and then run on up. It could easily just go to 140 and then keep going down. It is IBM. But I think the perception in the game has changed. There's a reason why IBM traded in an $8 range today, the most it's had since 2010. It opened at the lows, it closed near the highs. The average trading range for IBM before today was $1.80. $1.80. 4.2x what the normal trading range is. 4.2 times. That's immense. Because if you could imagine what the volume was like, it was nearly 4x. 4x meaning 4 times. Average 3.3 came in at 12.695. So let's say 12.7 million shares. 4 times the normal volume, 4 times the normal range. This is a huge momentum bar. We'll have to wait and see what the follow through is. But don't be surprised, ladies and gentlemen, that they start making a new 52-week high. And then don't be surprised if IBM starts going on a tear. I never thought I would ever see IBM back at $200. Let me see. When was the last time they were at that price level? Over 5 years ago. It's because how poorly business has been. But you could see they're in a beautiful uptrend this year. Beautiful. It's rare we ever say that IBM is up 30-40%. It's rare. It wouldn't surprise me if IBM starts acting and behaving and breaking out like stocks like Twilio. And you could even say Adobe and CRM. And I don't think it'll act like Vive and Coop. Coop, C-O-U-P. Freaking new all-time highs every single day. Coop opened this year at $60. We just hit 146.58. They're up 80 points. No, I don't think it'll jump on that scale. But don't be surprised, guys and gals. Don't be surprised that they're much closer to 200 than 140. Considering they're at 149, that's a hell of a call. And again, they could go back to 140 and then go. But maybe they just never go back. I would keep an eye on IBM, ladies and gentlemen, because I am. 150 to 154 is going to be one hell of a range for the stock in the near term. If it pulls back, ideally, the price range that I'm going to be looking for is somewhere between 145. Oh, yeah, it was 145 to 144 to find huge technical support. They're way above their moving averages. What they have found support at recently was a 20-period simple moving average, but that's a very, very aggressive and short-term moving average. But historically, they've referenced it clearly at resistance, clearly as support. So if you trade, there's a small layer of support that's going to be following you here. But again, Are you going to be buying the stock if the market's down 400 points? Just be patient at that point. If the market's risk off and down 60 points, you should strongly consider a buy in IPM because you're not in extremely volatile conditions and the stock is trending up higher. Now, this is not a true recommendation. I'm not telling you to buy IBM, but I am telling you that this stock has potential that may not have been seen, may not be considered, or may not have been noticed. Only time will tell. I did say light was going to break out, and ultimately light is right back to where we started. We're still slightly up. I started looking good. I mean, it got up to 55.96, so it was up to 56. We're in at 53.75s, but it's held back. Why? Well, I mean, if you look at what the markets have done, we've had 1, 2, 3 straight down days in a row. Fed Williams, though, to the rescue today. And FOMC meeting coming up on the 30th and 31st. We'll have to wait and see. But back to IBM before I wrap this up. That 145 to 145 half to 144 level is going to be oh so important for support. Otherwise, that 20 period simple moving average currently right now, where is it? I'll have to expand this really big. Okay, it's 140.88. It'll probably be above 142 by tomorrow. Will be your next layer of support. My current ATR is at 141.33. I didn't have that quintessential gap bar. I probably will look for it to consolidate and look for the breakout maybe. Maybe the pullback if it's not too quick. But I'll tell you, I'm in love with IBM. And I never thought I'd say that. Come on, Watson, make me look smart. I think that's kind of what your business is all about anyways, right, Watson? All right, folks, I hope this was informative, and I hope you already knew about IBM, but I'm giving you at least some points of references, an ideology, an idea, some structure, something to let you know where it could possibly go. Who knows? We'll have to wait and see. I'm bullish on the markets, I'm bullish on Dow components, and I'm certainly bullish on IBM. Historical type of day. Don't sleep. Folks, if you have questions, make sure you send them to me. Podcast at Prosper Trading. Like us on our socials at Prosper Trading, and myself, the Disciple of Trend, on Twitter. On YouTube, click like and subscribe. Leave a comment below. What should I talk about next? Did you like me talking about the timing? Do you want me to go more into where traders are having difficulties? Again, this is about you guys. It's infotainment. I'm going to be talking. I'll be chopping it up. I do it every day anyways. But if you really want help, you want growth, you want ideas, let me know. I'm here to help you out. Next podcast may be a doozy, so stay tuned. In the meantime, I would love to hear from you. And of course, don't forget, like, comment, subscribe, and share. Ladies and gentlemen, have a great evening, and I will see you next time.
Don't forget to like, comment, and subscribe. Also follow us on our socials, Facebook, Twitter, and YouTube. If you have any comments or questions, you can email me, podcast@prospertrading.com. Thanks, everyone.